Hi boys and girls, today we're going to dive a bit deeper into the covered calls. Okay, so now we have some idea on how this strategy actually works. Basically, we just need 100 shares and one short call contract. Now let's learn a little bit more. Usually it is a good idea to start with a profit graph just so you can visualize what will happen to your option price on a different underlying price levels. On the graph, you can see that your profit is limited. Even if your stock will double, you will still have to sell your shares, which are covered by this option contract at the strike price. But on top of it, you will also have your option premium. So if the stock rise will be moderate, you are still in the winning position. If the stock has increased a lot, well, the shares will be called away, but technically you will not lose anything from your deposit. You actually earn here because you will get the profit from the option, but the idea of selling the stock for cheap is always difficult. On the other hand, you can see that you also have some kind of downside protection here in the form of option premium. So if the stock falls a little, you will be hedged with this fixed option premium. But if it falls more, of course, you will lose on shares. But if you bought the stock as an investor, then it should not be a problem anyway, right? As an investor, you can just buy more. Now, let's talk about covered call types. They differ mostly by the strike price. So you can set up your strategy with out of the money or with in the money options. Another thing to choose is the date to expiration, but it is usually the same in this type of strategies. It is usually around 40-50 days because the theta decay is the highest in that range. So if you sell an option which has 40 to 50 days to expiration, it will lose in price the fastest. So let's focus on strikes for now. The out of the money covered calls provide the highest potential rewards, but they have the smallest risk protection. So if you want to profit from the passage of time and you do not want to lose your shares, you can go with out of the money options. If you want to take a defensive position, if you expect some kind of small correction, for example, you can sell at the money or in the money call. This is because in the money and at the money options are just more expensive, so you will get more money from them. But they are riskier, which means that if the stock will not move by expiration, your shares will be taken away. A simple example, if the stock is currently at 45 and there are two possible option contracts, one with the 40 strike selling at $8 and one with a 50 strike selling at $1. The $40 strike provides 18% protection, while the 50 strike provides just 2% protection. On the other hand, if the stock will not fall lower than that strike, you will have to sell your shares at $40. But if you expect the stock to increase, then the 50% strike is the way to go. The stock can easily rise by 25% and you will also get a bonus, which is $1 from the option premium. Chances that the stock will rise by 25% are low, so the probability that you will have your shares and the option premium are pretty high. Now, how to compare different covered call strategies? Usually, you will need to compare the capital you need to invest to actually get those 100 shares of stock, and then you will need to calculate the max profit that you will get from each of those strategies, and of course, break-even points. Based on this data, you should be able to see which strategies will work best for you. The formula for calculating the max profit is on the screen. You just need to subtract the sum of purchase price of your shares and the strike of the short option, and subtract the result from the premium that you received from the option sale. And do not forget to subtract all the commissions and margin interest as well. As for the downside break-even point, it can be calculated by subtracting premium received from the purchase price of your underlying. As long as you are higher than that value, you are still profitable. Let me know if this video has helped you to understand the technical details on covered calls, how to compare them, and how to calculate the max profit or break-evens. If you still have some questions here, then please leave them in the comments below and we'll try to figure them out. The next video will give us more ideas on what to do if the trade goes against you. There are a couple of follow-up actions and they will help you to earn more or to protect your profits. Stay tuned, be awesome, and like the video.